The Fed raised interest rates 50 basis points this week. And I had been saying that I thought that would be a mistake. The markets are corroborating that it seems that the Fed is making a mistake. So we've seen the stock market go through a spasm. The S&P now from its peak is down 15%. The NASDAQ from its peak is down 25%. Pure play innovation strategies like ours are down 60 to 75%. So that's not just a spasm, that's a convulsion.
Hey guys, welcome back to Library of Wealth. Today we have ARK Invest Cathie Wood giving us her prediction for a recession in the current market, as well as the impact that the rising interest rates and the crashing in stock and crypto markets is having. Cathie will also go over her financial outlook for the coming months, as well as what she thinks the Fed will do next. Now, even though we're in a recessionary climate, Cathie says we haven't seen the worst of it. She believes that the current trajectory we're seeing now is only a precursor for what's to come. We'll take a look at her predictions along with her investment thesis, and we'll see how that's going to affect the stock, crypto, and capital markets up until the end of the year. Make sure to stay till the end of the video to hear what Cathie's projection is for the current market crash, recession, inflation, and how the increase in interest rates will affect the financial markets.
You'd think that innovation companies that are not in benchmarks are witnessing the end of their world. It couldn't be further from the truth. This is a huge inefficiency in the market, this tendency to move towards benchmarks in risk-off environments. It's ridiculous that the genomic revolution and blockchain technology and crypto assets are all behaving exactly alike. In fact, crypto assets began to correlate highly with the NASDAQ starting at the beginning of COVID. Before that, there was no correlation at all. And so we think this is an anomaly, a massive anomaly, and that with time it will correct and the efficiencies will be introduced back into the market. So that's the stock market. The bond market this year, year to date, if you use the 10-year Treasury yield and its proxies prior to 1940, year to date through April, and I'm sure even more so through today, the bond market has not seen worse performance since 1788. Think about that. This is like a tsunami and an earthquake together. I used to describe what was going on in the bond market as an earthquake, given the very low base of interest rates from which we started. Now, you might be asking why would that be true, given that the bond market was just a terrible place to invest in the 70s when inflation was taking off?
Cathie goes on to say that within a year, there has been a sudden restraint on both monetary stimulus and fiscal policy stimulus, and there doesn't seem to be any in the near future. Now, the potential for a tax package for financial relief, Cathie says, is extremely low because of the midterm elections right around the corner, as well as the economic downturn with rising gas prices, as well as foreign conflicts. Wood says that China and Europe are already in a recession.
Well, the difference between now and then is back then there were huge coupons. You know, interest rates they were paying were starting at 6, 7, 8, 9%, whereas during COVID we got down to 0.5%. So the base from which we're starting is very low, and that's why we now have a tsunami. The 10-year Treasury yield has gone this year from roughly 1.13% to 3.11. Again, huge percentage increase. High yield bonds, well, their spreads have increased, and now their spreads are relative to that Treasury yield. And so their spreads have gone up from 2.45 to 4.08. So in addition to the 200 basis points or the 2 percentage points that the underlying bond has gone up, they have gone up another 150 basis points. So credit is becoming much more expensive. On a year-over-year basis, spending is down 20%. This is another big break on the economy. We've gone from, monetary stimulus and fiscal policy stimulus to restraint on both, and that's very sudden within a year's time. And of course, we are comparing against the stimulus payments last year, so it's not surprising. We wouldn't expect to continue those, but nonetheless, that is a break compared to where we were. And I think the odds of any tax package going through, or Build Back Better going through, is very low. We're in midterm elections. Things are not going well generally for the economy, gas prices, Russia foreign policy, Russian-Ukraine war, and so forth. So I don't think that anyone who's going to be a part of the midterm elections will want to participate in controversies around any of those. Last month on YouTube, I gave 2 points of view. Everyone's looking at the same numbers, but there were 2 points of view that were very different from one another. One was the economy's charging ahead, inflation's going to continue, rates will continue to go up, we don't think there'll be a recession, and so forth. And then the other one is, whoa, watch out, inventories are building, consumption is slowing down, consumer sentiment is falling apart. We risk a recession here. And oh, by the way, China and Europe are in recession. I think that the first camp is capitulating to the second camp. It's still fighting this notion that GDP actually fell. This in real terms now, take away inflation, GDP unit growth fell quarter to quarter at an annual rate by 1.4%. The consumption of goods slipped slightly. That's what we're expecting. Meanwhile, inventories are piling up. Government spending went down, as I mentioned. Imports surged. And so a lot of those economists and strategists in the first camp were saying, oh, that's exogenous. That's an anomaly. You've got to adjust for that. No, you don't. Imports surged and went straight into inventories. They canceled each other out. What's so fascinating about the world of economic experts today, some were trained in economics, to be sure. Many were not. They were trained. They learned after they got their MBAs, and maybe they didn't go into the depth that many of us had to back in the day when everybody came into this business with an economics degree. So there's a lot of superficial analysis out there, and a lot of cherry picking also in terms of indicators. So we do think that a recession is quite possible here in the United States. A recession is defined as 2 consecutive quarters of declines in GDP. We've had one, and I wouldn't be surprised to see another either in the second quarter or the third. So technically, if we were positive in the second and went negative again in the third, that's not a technical recession, but in my book, it's close enough. Real average hourly earnings have been falling since April of 21 on a year-over-year basis. They were down 3.4% in April of 21. They're still down 2.6%, but there's been a consistent decline over the past year. And I think those in the high inflation camp expected wage growth to continue accelerating. That is not happening. And I think that's the linchpin of those who think that inflation is out of control and is only going to get worse. So we're paying a lot of attention.
Some have been predicting that inflation would spiral out of control. Over the previous few years, the Fed has been overly optimistic about the prospect of lowering inflation. They'll have to do a lot more than a 0.25 percentage point hike every few months if they want to remain ahead of the curve and slow the economy. Without recessionary measures, we've never seen such high inflation. It's up to the Fed to bring it under control and skillfully navigate the global economic and geopolitical challenges. What do you think about Cathie Wood's economic outline? Comment down below. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.